Welcome to the deep dive. Our mission, as always, is to really get into the details, the insights from the sources you share. And today we are taking a deep dive into the stock market rotations, specifically what's been going on in August 2025. We're using an analysis from Lucas Downey over at moneyflows.com. He really focuses on, why money moves. And right away, here's the big idea. Money rarely just leaves the markets. It rotates. We've definitely seen a lot of that bobbing and weaving lately. Now, some people might immediately think, oh, nerves before Jackson Hole, right? That's the common take. But our source points to something maybe more basic, just typical low liquidity summertime weakness. And this pattern, well, it often shows up in August and September, seasonal stuff. But here's the potentially good news, and the source really stresses this. While things might feel a bit bumpy, these cool-down periods, especially after those monster rallies Lucas Downey talks about, they actually open up a real window of opportunity. Okay, so let's unpack that a little. One key thing from the source is how equities tend to swing, back and forth between extremes. Remember April. That extreme capitulation, they called it. Just intense selling. And well, ironically, that actually set off a huge rally, a ferocious one. What we're seeing now, though, according to the source, isn't that kind of decline in unison where everything drops? It's more like a healthy rotation. So money moving from hot areas to ones that were lacking behind.
Right. And that term healthy rotation, it's important because it signals a real shift in how investors are behaving. It's not panic selling. Our source mentions the big money index, the BMI. It tracks the big institutional players. And seeing that fall from overbought territory, well, that's a pretty classic signal that more volatility is probably coming. It tells you the market's adjusting under the hood, not just collapsing.
Yeah, and you can really see that shift when you look at the August numbers. It's quite striking. Growth stocks, which were flying high for ages, they've definitely felt some pressure. But then you see these defensive areas starting to perk up. Okay, so for example, since around August 14th, near that recent peak, the PHLX semiconductor index, it's a big one for tech hardware, dropped 4.33%, quite a dip. And the NASDAQ 100, heavy on growth, down 2.45%. So you see those numbers, and it paints a picture of investors deliberately, maybe tactically, pulling back from those high growth names.
Exactly. And to really hammer that point home, look at the groups that were underperforming. They're suddenly showing some life. So the S&P 500 equal weight index, that one's interesting because it gives every company the same weight, right? Not just dominated by big tech. It actually managed a tiny gain, 0.05%, barely moved, but still green. And the Russell 1000 value index up 0.16%. So the fact that the equal weight S&P is basically flat, that really tells the story. You've got clear winners and losers. It's undeniable rotation happening. Money's clearly flowing out of those really popular high-flying stocks and moving into more defensive, maybe lagging areas like textbook.
Okay, let's go even deeper then. Sector level. If we look at the S&P 500 sector returns starting July 30th, that's when the BMI started to head down. The picture gets even sharper. You've got sectors like energy, tech, industrials. They've fallen. But then healthcare, materials, staples, they actually soared.
Right. And if you connect those dots, that sector movement, it looks like typical risk-off positioning. It really signals that, the summertime doldrums, as the source calls them, are here. And the source really highlights the pain in some specific growth names, calling them the highest flyers, getting their wings clipped since August 13th. You mentioned Palantir, PLTR, down a hefty 15.38%.
Wow.
And MicroStrategy, MSTR, dumped 11.68%. Even a giant like NVIDIA wasn't immune, dropped 3.41% during that tech dip. And the source also brought up a really interesting point about tech flows. For months, it was just nonstop inflows into tech stocks, constant buying. But that's changed. Now it's described as more and more equities come under distribution, basically big blocks of shares being sold. ServiceNow, now a W was the example given. And the note there was, once these outflows start, well, they often stick around for a bit. It's not usually one-day thing.
Okay, so what's the takeaway here? What does it all mean? It's easy to just say, oh, inflation fears or nervousness about Jackson Hole. And yeah, those narratives are out there.
Sure, they play a role.
But what our source finds really fascinating is how this current pullback, under the surface, it kind of rhymes with history. The author's preferred explanation is, well, pretty simple, actually. Traders are on vacation right now. Volumes are extremely light.
The classic summer slowdown.
Exactly. And that, crucially, opens the door for added volatility. It makes sense, right? Fewer people trading means even smaller trades can push prices around more easily.
Yeah.
Leads to those sharper swings we've been seeing.
Yeah, which brings up that important question. Is this just random noise or is there a pattern? And according to the historical data in the source, not random at all. It tells us that going back to 1990, late July through September, It's generally a seasonally weak patch for the S&P 500. Average returns are actually negative during this period, and often it is linked to those later summer volumes, making the market just, well, more vulnerable to dips. It's a known cycle.
Okay, but it's not all doom and gloom. Our source really emphasizes the flip side of the opportunity here. They keep saying these cool-down periods are needed after monster rallies. It's not a disaster signal.
No, it's actually healthy.
Right. It's presented as a strategic moment, a clear window of opportunity if you've been patiently waiting to buy the dip.
And that's potentially a really significant opportunity because the seasonal weakness we're seeing now, historically, it often spills over into seasonal bullishness starting around October. So the core takeaway, really the call to action for you listening, is maybe start making your buy list now. The source advises that, once that tide turns and money starts flowing back into growth, you'll want to be ready. The advice is pretty direct. Buy any summertime dip. Ride the rip.
So there you have it, our deep dives into this August 2025 market rotation. It's just such a powerful reminder that money doesn't usually just vanish, right? It shifts. And understanding these underlying moves, these seasonal tendencies, well, it could give you a real edge.
Yeah, absolutely. And maybe the final thought for you to consider is this. Given these historical patterns and seeing this rotation play out right now, how might understanding these deeper market mechanics change your view on volatility? Maybe not just seeing it as something scary to endure, but perhaps as, well, a predictable cycle that actually creates potential windows of opportunity.